Good morning. It's July 26th today, and almost 4+ decades in multiple businesses, working as a CEO, CFO, consultant across the globe. I've realized some truths which I would like to share with you. So, today's topic is the hidden science of deal architecture. What if I told you that some of the world's biggest acquisitions were completed without the buyer writing a massive check? Sounds impossible? After all, we've been taught one simple rule. If you want to buy a company, you need money. But what if that rule isn't entirely true? What if that most valuable asset in an acquisition isn't cash, but structure? Welcome to the fascinating world of deal architecture, where strategy often outweighs capital, and where the smartest acquisitions are engineered, not merely financed. I'm Raj Sukeja. Today we are going to explore one of the most misunderstood subjects in corporate finance: how companies acquire businesses without using their own money. Money isn't the real currency. Let's begin with a simple question. Why do business owners sell their companies or their equity, either in part or in full? Is it always because they want cash? Not necessarily. Some founders are looking for retirement. Others have succession issues. Some need to access global markets. Others are struggling with debt, family disputes, technology gaps, or some simply want their life's work to continue under capable leadership. When you understand the seller's real motivation, you stop negotiating only on price. You begin solving problems. And that's where extraordinary deals begin. The difference between price and value. One of the biggest mistakes entrepreneurs make is confusing price with value. Price is today's number, value is tomorrow's opportunity. Imagine paying $50 million for a company that generates another $200 million in future value after integration. Did you overpay? Did you buy future cash flows at a discount? Professional deal architects never negotiate today's price alone. They negotiate tomorrow's value. That's a completely different mindset. When I look at a deal, I look at the potential value of the company, not just the price today. And it doesn't mean that you have to pay a heavy price today either. It's the perception, the narrative that you carry to the seller that is important. We've helped many buyers reduce prices, negotiate better deals, structure legal contracts that could have been, a problem in the future, and got them financing as well. The acquisition toolbox. So how do companies actually buy businesses without large amounts of cash? Let's explore some of the powerful tools. Seller financing. Instead of demanding full payment upfront, seller agrees to receive payments over several years. In effect, the seller becomes the lender. The acquired business generates the cash that eventually pays for itself. Second, earn-out agreements. Instead of paying for projected success today, the buyer pays only if the company actually achieves financial targets. Risk becomes shared. Trust becomes measurable. Third, share swaps. Instead of cash, the seller receives ownership in the acquiring company. They are no longer simply selling, they are becoming partners in future growth. Fourth, leveraged buyouts. Perhaps one of the most famous acquisition structures. Here, lenders finance much of the purchase because they believe the acquired company's own assets and future cash flows can support repayment. The business helps finance its own acquisition. Fifth, asset-based financing. Inventory, receivables, real estate, machinery, patents, licensing income. These aren't just assets. They are financing opportunities. Sophisticated buyers know how to unlock value that's already sitting on the balance sheet. Negotiation is capital. Here's something many entrepreneurs never realize. Every dollar Every rupee you negotiate is a rupee you don't have to finance. Negotiation itself creates capital. The best negotiators don't spend all their energy arguing over purchase price. They negotiate payment timing, working capital, transition support, escrow, tax treatment, consulting agreements, employee retention, and dozens of other variables, because every variable carries financial value. Trust reduces cash. Here's something spreadsheets can never calculate: trust. Founders often spend decades building a company. They're not just selling machinery, they're transferring employees, customers, relationships, reputation, and even their identity sometimes. When buyers demonstrate integrity, competence, and respect for the founder's legacy, sellers become far more flexible. Ironically, the more trust you build, the less cash you often need upfront. This is also one of the tools that we use. We, as a neutral party, as Red Mammoth, come into play, help you build that trust with the seller, and help you build that legacy that may be required to carry it forward, and therefore reduce your cash burdens. Synergy, the invisible currency. Now let's discuss the most misunderstood word in acquisitions: synergy. Imagine two businesses generating $20 million each in annual EBITDA. Separately, they create one level of value. Together, they eliminate duplicate costs, share purchasing power, cross-sell customers, expand distribution, integrate technology, improve efficiency. Suddenly, combined earnings are significantly higher, and that increase in value wasn't created by writing a bigger check. It was created through integration. Sometimes those future synergies justify the acquisition entirely. Due diligence creates financing. Banks don't finance uncertainty. Investors don't finance guesswork. They finance confidence. Strong due diligence reduces perceived risk, and when risk falls, financing becomes easier. That's why professional buyers invest heavily in understanding every aspect of the target business before signing the agreement. Knowledge lowers the cost of capital. AI and the future. Today, AI is changing the acquisition landscape. AI can analyze customer concentration, detect financial anomalies, model cash flows, predict integration risks, evaluate contracts, and simulate hundreds of acquisition scenarios in minutes. The future belongs to professionals who combine financial intelligence, expertise with intelligent technology. Data is becoming one of the most valuable forms of capital. Ethics matter. Let's be absolutely clear. Creative deal structuring should never become deceptive deal structuring. The objective is not to avoid paying. The objective is to align risk, reward timing, and value for everyone involved. Great acquisitions create wealth for buyers, for sellers, for employees, for lenders, for customers, for vendors, and ultimately for society. Without ethics, even the smartest structure eventually collapses. So can you acquire a company without money? The better question is, can you acquire a company without understanding value? Because money is only one tool. Structure, trust, timing, negotiation, vision, financial engineering. These are the real drivers between transformational acquisitions. The world's greatest deal makers aren't simply raising capital. They're designing possibility, they're solving problems, they're aligning interests, and they're creating value where others see limitations. If this video changed the way you think about acquisitions, let me know in the comments. What topic would you like me to cover next? Cross-border M&A, private equity, leveraged buyouts, hostile takeovers? What is the psychology behind billion-dollar negotiations? Enjoyed this discussion. Don't forget to like, subscribe, and share it to someone who said money is the only way to buy a business. Because the greatest deals are rarely built on cash alone. They are built on imagination, integrity, and intelligent deal architecture. Thank you for watching. This is Raj Sukheja signing out.